A private equity consortium paid $6.6 billion to buy a toy store in 2005. They loaded it with $5 billion in debt. 12 years later, the company was gone. This is the story of Toys R Us, but it isn't a story about Amazon. It's a story about a financial weapon that turned a stable business into a zombie, and the precise moment its owners chose not to save it. In 2005, Toys R Us was the world's largest dedicated toy retailer. It was struggling against Walmart and Target, but it had a clear path forward. Then, in a single boardroom decision, its future was sold. The buyers, Bain Capital, KKR, and Vornado Realty Trust. Their strategy was the classic leveraged buyout. Use borrowed money to buy the company, then make the company itself pay back the loan. For Toys R Us, that meant $5 billion in new long-term debt. To give you a sense of scale, that's more than the company's entire annual revenue. The debt came with a price tag, $400 million per year in interest payments. That's not an investment in the business. That's a pure extraction, straight out of the company's cash register. Think about what $400 million could do. It could build a world-class e-commerce platform. It could modernize hundreds of stores. Instead, it went to service the debt that bought the company in the first place. Here's the part nobody talks about. The debt never went down. From the moment of the buyout until the bankruptcy filing 12 years later, the principal remained at roughly $5 billion. The private equity owners weren't foolish. They saw a potential escape hatch. In 2010, they announced plans for an initial public offering. If successful, it would take the company public again and use the cash to pay down the debt. But the IPO was never completed. The owners canceled it in March of 2013, citing market conditions. And this is the critical pivot point. With that public exit off the table, Toys R Us was now completely trapped. After 2013, the company never posted another annual profit. Its quarterly losses began to accelerate. In early 2017, it lost $164 million in a single quarter. Toys R Us knew it was in trouble. In 2014, it launched the TRU transformation, a plan to declutter stores, clarify pricing, and integrate online shopping. It was a good strategy. It was also a decade too late. In 2015, they tried the Toy Lab concept, interactive play areas designed to make stores a destination. It was exactly what retail experts said they needed. But with $400 million leaving the building every year, they couldn't afford to roll it out. The numbers tell the story. More than 40% of the company's entire sales happened in the last 3 months of the year. It lived and died by the holiday season. One bad Christmas could be fatal. In December 2013, a snowstorm caused foot traffic to drop 9%. The company's response was desperate. Keep stores open for 87 consecutive hours straight. Hire 45,000 temporary workers. It was a frantic attempt to survive the quarter. This is the midpoint reality check. By 2015, the business itself was still salvageable. The brand was strong. The concept worked. The problem wasn't retail strategy. It was a balance sheet problem, and the owners had the power to fix it, but they chose not to. Instead, they waited. They allowed the debt to continue draining the company of the cash it needed to fight back against Amazon and Walmart. They treated it like a cash cow, not a patient needing care. By September 2017, the bloodletting had to stop. Toys R Us filed for Chapter 11 bankruptcy protection, citing $5 billion in long-term debt as the direct cause. They had 64,000 employees facing an uncertain future. The filing was a last-ditch attempt. They needed to borrow $2 billion more just to buy inventory for the upcoming Christmas season. That's how deep the hole was. They couldn't even afford to stock their own shelves. It was the final blow. In March 2018, the court approved full liquidation. Every store, every employee, every piece of history, gone. Isaac Larian tried to buy 400 stores for $890 million, but the bid was rejected. The only part that survived was Canada. Fairfax Financial bought 82 stores for $234 million. It was a fraction of what the U.S. operation was worth just years earlier. On June 29, 2018, the last U.S. Toys R Us closed its doors forever. 70 years of history ended. But the damage went far beyond one company. The collapse left a $4 billion hole in the toy market. Competitors scrambled to fill it. Party City opened temporary pop-up stores. Amazon expanded its toy section. The value that Toys R Us had created simply migrated elsewhere. So let's answer the central question. The collapse of Toys R Us traces back to one decision, not the 2005 buyout itself, but the decision to never take the company public again in 2013. When the owners canceled that IPO, they removed the company's only mechanism to shed its debt. They locked it in a room with a $5 billion anchor and closed the only door. Every subsequent struggle, from store makeovers to holiday scrambles, was a fight with one hand tied behind its back. The lesson is brutally simple. Leverage is a tool, but when it becomes the business model, it guarantees you have no margin for error. Toys R Us wasn't killed by the future. It was killed by the financial structure of its past.